Putting together a solid investment portfolio can help you grow your wealth over time. Most people know that already, but figuring out what options you have to invest in can feel overwhelming, especially if you're just learning about investing. So let's look at some of the best and most popular investment avenues out there. Number 1, high-yield savings accounts. Some online savings accounts and money market accounts can give you better returns than regular bank savings or checking accounts. When we say better returns, we mean interest, money you can make from simply having your cash sitting in the account. Typically, bank accounts may get you around 0.01% interest, meaning for every $1,000 you have, you'd make 1 cent. But currently, in 2024, high-yield and money market accounts are offering around 4.5%, which means for every $1,000 you hold in an account, you'd make 45 bucks. These accounts are great for emergency savings or money you don't need to touch for a couple of months or years. Think a house down payment fund or new car money. If you're just starting with saving and investing, it's a good idea to keep 3 to 6 months worth of living expenses in one of these accounts as an emergency fund before you think about the other investment options we'll talk about later in the video. Number 2, certificates of deposit. A certificate of deposit, or CD, is generally a federally insured savings account with a fixed interest rate for a set period of time. Set periods can range from a few months to 3 or 5 years. So if you want to grow your money safely for a certain goal within a specific time frame, or you know for sure you won't need this money during that time, CDs could be a good fit. What's nice about a CD is that it typically offers a little more than the high-yield savings account, and it locks that rate in, meaning interest rates can drop and you'd still get whatever your locked-in rate is. At the time of this recording in 2024, they're offering around 5.5%. But the caveat is that it locks your money up for the duration of the term limit. If you ever needed to get to that money before the maturation date, you could be hit with additional fees. Number 3, bonds. Bonds are a fairly safe way to earn some fixed income. Bonds are issued by governments or companies that want to raise capital. You, the investor, loan the money by buying the bond, and in repayment, the government or company issues you interest payments until the maturity date, at which point they also pay back your principal. Investors like bonds because they can provide steady and predictable income streams with those interest payments. Lower risk bonds like government or some corporate bonds usually pay less interest compared to riskier ones. Let's talk about a few. A government bond, like a treasury bond, is a loan you give to the government. They pay you interest on this loan over a set period, usually 1 to 30 years. Corporate bonds are kind of like government bonds, but instead of loaning money to the government, you're loaning it to a company. Depending on the risk factor of the company, the interest rates can vary. Municipal bonds are typically issued by states and other municipalities. High-yield bonds, also called junk bonds, can be even riskier and act more like stock in terms of how they perform. They offer higher interest rates to compensate for the higher level of risk an investor is taking on. Because you get a steady stream of payments, bonds are called fixed income securities. Government bonds are typically considered risk-free since they're backed by the government. But the safety of government bonds means you won't see as high of a return as you might with other investments. If your entire portfolio is made up of bonds, instead of a mix of stocks and bonds, it's going to be a lot tougher to hit your retirement or long-term financial goals. If you're looking for a fixed income investment with potentially higher returns than government bonds, and you're willing to take on a bit more risk, corporate bonds could be a good fit. They offer a little bit more money, but still less ups and downs than stocks or even real estate. Because these loans aren't backed by the government, they're considered riskier and would generally provide a higher return. So with corporate bonds, the higher the potential yield you might get, the riskier the company. On the other hand, if you go with bonds from big, stable companies, you'll likely get a lower yield. Make sure to find the perfect balance between risk and reward that works for you. Now, before we head to the next investment type, if you've gotten good information from the video so far, please consider liking and subscribing to the channel. Now, let's take a look at the next investment type. 4. Funds. If you don't want to research individual companies and pay heavy attention to specific sectors of the market, but you still want to invest, then investing in funds might be right for you. Think about a fund as a basket of assets. They're ideal for people saving for long-term goals because they provide easy access to the potentially high returns of the stock market without needing to handle a portfolio of individual stocks. Let's talk about a few. Mutual funds allow you to pool your money together with other investors to buy stocks, bonds, and other investments. They're a cost-effective way for you to diversify, spreading your money across various investments to reduce the risk of losing money on any single investment. Some mutual funds focus on specific criteria, like certain types of companies or industries, allowing you to target specific investment niches that align with your goals. Index funds are a type of mutual fund that holds the stocks in a particular market index, for example, the S&P 500 or the Dow Jones Industrial Average. The aim is to provide investment returns equal to the underlying index's performance, as opposed to an actively managed mutual fund that pays a professional to curate a fund's holdings. They are more cost-effective due to lower fund management fees and less volatile than actively managed funds that try to beat the market. Index funds can be especially well-suited for young investors with a long timeline who can allocate more of their portfolio toward higher-returning stock funds than more conservative investments such as bonds. Exchange-traded funds, or ETFs, are like mutual funds. They pool money from investors to buy a bunch of different investments all at once, which gives you a diversified portfolio in one shot. But they're typically passive, meaning no active manager curates the portfolio, and they also tend to track a specific index or sector. There are a couple of differences between the two, though. Mutual funds are only traded once per day at a set dollar amount for all investors, and you must buy a whole share. Whereas ETFs are traded like stock, which means you can buy partial shares. This also means that the price of the ETF can be different between the morning and afternoon, allowing investors different buy-in prices. ETFs are perfect if you don't have enough money to meet the minimum investment requirements of a mutual fund, because you can buy ETF whole or partial shares at a lower price. Number 5. Stocks. For investors who already have a diversified portfolio, stocks are absolutely worth considering. When you buy a stock, you're buying a piece of a company. Stocks can give you a higher potential return than safer investments like government bonds, but they also come with more ups and downs. Because individual stocks can be volatile, it's generally advised to keep your holdings in any single stock between 5 and 10% of your total investment portfolio. Some companies can offer an income stream in the way of dividends, so they can offer an income stream like bonds, but they also have the potential for growth like regular stocks and stock funds. Now, dividend stocks might not see the rapid price jumps you sometimes get with newer, growing companies because they're typically from stable, older companies. But many investors like them because of the steady income they provide. Keep in mind, if you hold dividend stocks in a taxable brokerage account, you'll pay taxes on those dividends in the year you receive them. This is different from stocks without dividends, where you pay taxes mostly when you sell them. If you're older and want more stability or regular income, sticking with stocks that pay reliable dividends could be the way to go. You can even plan to take those dividends as cash, which could be a solid part of your strategy for steady income in your non-working years. Now, what you should consider. When you're figuring out where to invest your money, there are a few important things to think about. First off, consider how comfortable you are taking risks, how long you plan to invest for, what you already know about investing, your current financial situation, and of course, how much you can actually afford to invest. If your main goal is to grow your money, there are different paths you can take, but knowing your risk tolerance can better direct you. Remember, it's often a trade-off between risk and reward in investing. A diversified portfolio tries to take a balanced approach, mixing safer investments with ones that have potential for long-term growth. The best investments are the ones that give you these choices, offering various levels of risk and potential rewards depending on your goals and comfort level. Thanks so much for watching. We hope you learned something new today. If you did, please consider sharing this video with a friend. It really helps us out. We'll see you in the next one.